Hi, everyone, and thank you for joining us today for our webinar, Credit Confidence, Strategies to Build, Rebuild, and Thrive. My name is Kelly Blount, and I will be today's moderator. We have an exciting agenda planned for you today on understanding credit scores, practical strategies to establish or improve your credit, as well as tips to avoid common pitfalls and stay on track. With that, let's go ahead and get started. I'm going to turn things over to Todd Moore, Director of Education with Trinity Debt Management, to introduce himself and take us through today's presentation.
Well, thank you so much, Kelly, and thank you to everyone joining us today. I'm Todd Moore with Trinity Debt Management. Always good to work with the credit union and always good to work with you. So we've got a pretty strong agenda for you today. Here we are heading into the end of October. The holidays are coming. For many of us, we may also be thinking about improving our credit in the new year. So lots to cover today. We're going to be talking a lot of detail about credit. But you may be thinking yourself about a large purchase. This may be a housing project that you're working on, maybe purchasing a new home, or maybe you need a car. And maybe your score at this point or just your overall credit capacity is just not as strong as you would like it to be. So we're going to be talking about ways and strategies to improve your credit. And then also, we're going to be moving into the holiday season. I'm going to challenge you to not overextend yourself. Lots of opportunities this season to make all sorts of purchases. And we know that it's easy to rely on credit cards and maybe even buy now, pay later lines of credit. So going to caution you about that. We certainly don't want to accumulate a lot of debt. And have those types of debts kind of keep us from being able to make these larger purchases that we may need. And then we're also going to be covering a lot of ground for just a whole range of maybe differences in where we're at this point in time. So maybe if you have a younger person you're working with, we'll be talking about that. Maybe you might be a thin file. Maybe you're just rebuilding that credit history and trying to figure out, how do I strengthen my score? And then for some of us who are just kind of stuck at this point, we also have tips for you too. So we've got lots ahead, and we're just going to go ahead and dive in. So we know that, having a strong credit score is just really key to having a strong financial future. We have to have credit to finance those larger projects that we're talking about today. And just maintaining a score sometimes is not enough. We need that extra push to kind of get into that higher tier to be able to open up better lines of credit for ourselves so that we really build a strong financial plan. Well, one of the ways that we're going to talk about this, I'm going to take us back for a moment and just really get into some of the details about how scores are developed and how they function and what all this stuff actually means. Okay, so when we think about the scoring side, I want to talk a little bit about how this concept of segmentation is related to scoring. Okay, so segmentation, you think about going into the credit union and you pull a score and your score comes up as, let's say, 645. Needs some work, well, that number itself is part of a segment. So your score is segmented. Sorry, it's part of a segment of a large group of scores that are pulled that talk about risk. It's really related to the credit worthiness or risk. So, and this really influences a whole range of things. So we're talking about insurance, auto loans, types of credit card offers, and all those variations on loan interest rates itself. So it's important to understand a little bit about segmentation. Sometimes you'll see pre-qualified offers come through the mail. And, large companies, banks and other companies will try to pull a segment based on zip codes. So, depending on where you're at and where you fall within that particular segment of data, your score pops up within that larger data pool. Certain offers will be sent to you as pre-qualified offers. Okay, so we see this all the time. A better way of handling things, so if you have those types of questions and whether or not you would qualify or not, we always want to work directly with you. So at General Electric Credit Union and at Trinity, one of the things we're always able to do is help you kind of avoid those pre-qualified offers and that use of segmentation of trying to come and kind of target you through the mail for lines of credit that you may not obtain. A better way is just working directly with us to pull a report, kind of understand where your score is at, and whether or not your score is strong enough to actually qualify for certain lines of credit. But the concept of segmentation, get familiar with that because it has a lot to do with scoring itself. And again, when we pull a data set, and we can do this by zip code as well, we can segment that larger data set based on scoring measures. And then depending on where you're at, that will influence the types of offers that you have. So segmentation and this evolution of credit itself, I'll just briefly talk about this. It's come a long way, so we think back about early lines of credit. Segmentation is something that's more modern. The evolution of credit itself, just to kind of paint this broad picture, when we think early on, it was very much kind of local lines of credit. We didn't have large data sets to work on. It's pretty much a handshake and a promise. And as things move through time, it's really where we move into this concept of regional bureaus. And then by the time we get to post-war America, this is where we really start to see the credit card market emerge, kind of post-World War II. And this is a time of, if you're familiar with this part of history, just coming back out of World War II, consumerism takes off, introduction of the credit card market itself, got to find a way to evaluate risk. So scoring is starting to develop, and also this concept of segmentation. So it's very, interesting how this whole story evolves through time, because, we talk about just localized lines of credit to being, now just immersed with all sorts of different credit scores. So we see this concept of credit scoring around us in all sorts of different contexts. There's bankruptcy scores, insurance scores, mortgage scores, all these sorts of things. So scoring itself has tremendous predictive value. So it's important that we kind of understand, what scoring is really, what's the logic behind it, and what is it really meant to do. So for banks, credit unions, think about, a handshake is just not quite good enough. I mean, how do we really know whether someone will pay us back? That's one of the beauty, one of the nice things, the beauty in credit scoring itself is that there's predictive value. We have some method of understanding, a certain loan amount is given. We can use certain factors to make assumptions about whether or not if there is risk involved. There's always risk involved. But what we can do is measure that risk, and we can figure out a way through credit scoring to have some predictive value in the market. So what we're going to be talking about today is the FICO model, which is the Beacon score 300 to 850. And I've just provided a series of different scoring ranges here for us. Everything from, the 800 being that exceptional line of credit all the way down into the 570s or below. For us today, if regardless of where you're at, we can always improve. Okay, it starts to be a little more tricky when we get up into the higher numbers, because in order to get, if you're in the 800 range, you probably have a long credit history. You've been doing this for a while. You've had a longer period. Time is an important factor when we're thinking about risk. So regardless of where you're at, however, knowing those factors and understanding something about scoring itself, that's always going to be to our advantage. We can always make adjustments, learn the model, and raise our score. So most of us, when we think about credit, I've listed kind of three fundamental types of credit here. Okay, so revolving, installment, and then service lines of credit. So we'll start with service lines of credit. So these are those ones that are kind of typical, like cable bills, cell phone, gym memberships, those sorts of things. Now, these things are not really reflected in our credit score itself, because these are lines of credit directly with that type of service. Now, where things can get a little messy for us is that if we've had a defaulted bill, that type of information becomes part of our credit report in terms of just collections, but it doesn't necessarily factor into our score. So when we're looking at scoring and we're looking at ways to just improve our capacity through time, really have to focus on these two here, which are revolving installment lines of credit. So revolving way to just shortcut this description, this is mostly in the credit card market, okay? So what we have is we have interest rate that you, depending on your payment amount, can shift. So the interest rate's one factor, but let's say you have a $5,000 line of credit. You use initially maybe $1,500, and then you begin to max that card out through time. The payment amount goes up. That differs than what we have through an installment line. An installment would be you borrowed $5,000, and we had set monthly payments throughout a loan term. So, but the importance of this is, what reports, what doesn't report, how significant are these types of credit? What does it mean for us? So again, revolving installment lines of credit, very, very important. Okay, those are the two that are always going to report to the credit bureau, has significant impact on our payment history and outstanding debt, certainly will impact our score. But these service lines of credit, and sometimes you might look at this as, things that are like rent to own falls into this as well. Those types of service lines do not report to the credit bureau. So while you're making payments and going through the actions of kind of paying these things back, it doesn't report to the credit bureau itself. So what's significant about this is that when we're building lines of credit, we really want to focus on those installment or revolving lines. And just, time is something that we just don't get back. So the better we can align our money and our time to those two types of credit, the better long-term credit capacity we will have. So I want to start, as I said, we got something for everyone today. So if we're looking at a younger adult, okay, what can we do to help that young person start down this credit journey? What's some of the steps that we could take that could improve some credit capacity? Well, a very simple way to do this, you think about the credit market itself. Credit market in terms of obtaining a credit card under the Card Act is 21 years old. So what can we do between 18 and 21 to start to build some credit capacity so that when we need to have a line of credit in that person's name, as opposed to just using what we call piggybacking, what are some of the steps? So I've just laid out a couple quick steps for you that I think can have tremendous value. So one, if you put a young person on what we call piggybacking, you essentially allow an authorized user, son, daughter, to become an authorized user on one of your cards. Now that does not mean that they're out using the card all the time, okay? They may not even have a whole lot of access to that, but what we're doing is we're using your line of credit to create some credit capacity for the other person involved here. So this would be a family member. How this functions is those purchases that are made also reflect in the payment history on a credit report for a family member. So it starts to build some credit capacity just by becoming an authorized user itself. So it's a very simple tool to use as opposed to waiting until 21 to start to establish lines of credit. You think about books, my daughter just started school, so we're getting books and all sorts of other expenses. But there are some ways that we can take some of those cash expenses that we would use, allow authorized user access, and use some of those expenses to actually piggy bank off my line of credit, or your line of credit can be used to do a very similar thing, where we can start to create some patterns on a credit report itself. Very, very simple to do. Two other ways is to use the credit union itself. So we can open a secure credit line, and this is a very simple way to do this. Just a small security deposit. And what this allows you to do, $300 or more, that will allow for a secured credit card. So that information is going to also report to a credit bureau. So you make a security deposit, and then you will be issued a line up to that amount, let's say $300. And all that access begins, again, it's an opportunity to build payment history, payment history being the number one factor in your credit score itself. So a great tool with minimal funds. And those lines of credit are offered through the credit union. So we would encourage you to ask questions and maybe even open a line so we can start that credit journey now. And then lastly, a credit builder loan. So this is, again, somewhere between $300 to $1,000. The beauty of this is that for that small amount, again, we could purchase items for school, or some things maybe for college, whatever it might be. And that cash expense, we can use those cash expenses to finance a credit builder line of credit, pay that off over the loan term, and establish payment history. So 3 quick tips that will help your young person establish credit now. Next, I want to talk about what we call a thin file. So there's a lot that can be said here, okay? What is a thin file? Typically, we might think about a younger person being a thin file. That is, if we pull a credit report, there's not much to report because a younger person doesn't have a long credit history. They haven't had very many lines of credit or any credit. So there's a thin file. There's not much to report. There's another side to this, however, though. You think about a number of people that maybe had bad credit in the past, they haven't used credit, or maybe they paid off a large amount of debt and they just were scared to get back into the credit market. Sometimes that reflects as a thin file as well, okay? So one thing we have to do here is that if we pull a credit report and you fall into what we would call a thin file status, then we've got to take steps to strengthen your credit history so that we build your credit history through time, so that you later can acquire those larger loans that you need. Car loans, home loans, those are the 2 big ones, many steps that I'm going to show you here, but it's I see this a lot because typically what I'll find is that if someone has paid off a large amount of debt, they just do not want to go back and open any lines of credit whatsoever. The downfall on that approach, however, is that at some point we do need a larger loan. We just don't have the cash to finance items that we need now. We have to have a line of credit. Therefore, we have to have a strong credit score. So if you fall into this idea of thin file status, again, what we need to do is figure out, what types of strategies or what types of loan products can we use that will help you move out of that status and then be able to get larger loans. So I've given you a couple examples here. So one, we're back to kind of the secured line of credit, credit builder loans, small personal lines of credit, small dollar loans. Now, what's great about a secured line of credit, we pull a credit report, you're a thin file, you just don't have a very strong score. And for some folks, if they haven't used credit for a long time, it may take 6 months or more to really start to generate a score. But with secured lines of credit, we bypass that. We can just basically use a security deposit to open a line now. We don't have to wait. We can just simply make a cash deposit, and the credit union will issue you a line of credit up to that amount. So let's say somewhere between $300 and $500. So with the secured line of credit, what we're able to do is we can turn cash expenses into an opportunity to build credit. So we walk in, we're a thin file, our score is lower, may not even have a score. We bypass all that by using a cash deposit, a security deposit. We're then issued a card up to that amount, and we can immediately start to rebuild our credit history just from using that secured card. And a very simple way to do this is that we would have a couple items that we budget around, let's say gas or groceries or maybe even a utility bill. We use our secured card to pay for those expenses, pay that off every month. We build payment history, and that's where our credit journey takes off. That's where we begin. Secondly, we could use what's called a credit builder loan. Works similar to what I talked about with a younger person. Small dollar installment loan. We pay that through, say, 12 or 24 months. Builds capacity over those 24 months. We'll get the loan amount at the end of that process. The number one factor for us is that we're having positive history reported every single month. That is going to move us, let's say you're in a lower tier or you're a thin file, that 24 months of positive payment history, that in addition to potentially having a secure credit card, those 2 factors alone start to strengthen our score through time. Great way to do credit building on 2 loan products you can obtain right now, regardless of your credit capacity. And then again, small dollar loans. This could be somewhere around $2,500. Maybe your score qualifies for a loan, but you just need you want payment history. That's the number one thing in order to build, a stronger score through that next 24 months. And then lastly, we're back to piggybacking again. This may be difficult for folks that are older. It's one thing to control that process with a younger person, but allowing, family members, husband, wife, partners, whatever it may be in your situation to be an authorized user, that can become, for some folks, just too high risk. So if that is the case, use those other options that I've listed here, secured or credit builder lines of credit. Those three right there will get the job done. So now I want to take us into this idea for the rest of us. We're not a young person. We understand that if I'm a thin file, there's several loan products and services that we can use right through the credit union. What about the rest of us? We need to enhance our score. It's not where it needs to be. I know that I'm planning out in 2026. I've got to make some things happen. I need a renovation. I need a car. I want to become a homeowner. What should I do? So we're going to talk about, if that's the situation you find yourself in today, I think this would be, we're really going to walk you through some steps that are helping you too. So one thing here is that first thing we want to do, when just get into the credit report itself. I encourage you to go and speak with a loan officer as well. So we want to work directly with you, as I've said earlier. Let's pull a credit report. Let's find out where you're at, and then that becomes part of our the information that we need to create and align strategies to raise your score. So if you have, if you're in the market right now, or you're making, plans in 2026, or maybe even need it now, that want to figure out, my score is kind of stuck, it's not moving that much, go in and speak with someone at the credit union. Loan officers are going to give you some good details about, what that scoring number should look like, what they're looking for. And if your score is not really strong, then let us pull a credit report for you at Trinity, and we'll identify, a baseline score, what factors that we need to look at to improve your score, and we'll just align strategies to help you. And at the end of that process, you're going to be able to go back into the credit union, work with a loan officer with a strengthened score, and then be able to obtain that line of credit. So it's a very simple process, but that initial conversation means a lot. So when we're thinking about enhancing our score, I believe that, again, the more you know about this process, the better. Okay, so we're going to be looking this afternoon at these three fundamental models, which are Experian, Equifax, and TransUnion. So we want to really get comfortable with those three bureaus, but we also want to differentiate between, various FICO scores and pay particular attention to what we call a Vantage score. And as you do this work, I want to encourage you, if you've pulled from annualcreditreport.com, you'll know that there's not a score. You can always purchase your score for, I think it's like $7 to purchase a score. If you want us to pull a report for you at Trinity, we're going to pull an Equifax report. But when you get that report and you get a score, you want to figure out in some ways, and this is what I'm hoping that you take away from today's presentation. What factors are, why is my score X? What factors have created this score? What's the outcome here? What's going on with my score? So when you look at that report, after today's presentation, I'm hoping that you'll be able to understand those 5 factors, the predictive value of scoring and what it means, and then also go back to this question: why is my score X? So if you're at that higher end, we know that certain factors lead to that higher score, and vice versa. If your score is on the lower side, what is it that created this lower outcome? Why is my score X? So when we do the work, we're initially going to go right to Equifax at Trinity, but the 3 major bureaus, I will encourage you to pull from the 3 major bureaus if you're doing credit building or just looking at your score, enhancing your score. So many folks that I work with pull from what's called a Vantage score. And this is, Credit Karma is the big one. Credit Karma is a wonderful tool. It provides lots of good educational value, but it's not used for lending purposes. So I've always said there's about a 30-point swing one way or the other, positive or negative. So But if we want a good read on where our score is at in real time, Equifax is a great way to pull that score, or through the major bureaus itself. The key is that we're not relying on a Vantage score to look at our overall score, because so often I work with folks and are like, oh man, I'm really ready to go in and buy this home, and they'll want a second opinion on their score. So I'll pull a credit score and come to find out, they relied on Credit Karma for a Vantage score, and we're 20 points off where we need to be. So again, we can't buy time. Time is important. So let's be efficient with our money and our time. Let's pull directly from the credit bureau itself. So here's the three bureaus and the scores that are used. We're talking today about the Equifax Beacon score, that 300 to 850. And then you'll see that the numbers start in different places. They have to differentiate themselves in the market. So we start, all three models are not going to be the same, although these 5 factors that we talk about are the same. So when we're looking at today's presentation, we're looking at the Beacon score from 300 to 850. And then again, why is my score X? Okay, so you pull a score, your score is 640, and you want to become a first-time home buyer. We need a little extra work on that score. We want to try to raise our score as best we can prior to obtaining the loan. Well, where in this model am I going wrong? Is it payment history? Is it outstanding debts? Where am I off? Okay, so, but when you look at this score, your score will reflect these 5 factors. And I've given you the point value here as well. So, when we think about the top 2 factors here, payment history and outstanding debt, we can learn a whole lot by looking at your payment history and then just your outstanding debt alone. Those 2 factors right there are going to be incredibly powerful for us to figure out, why your score is either, lower or needs some work. And then there's also some things here I'll share with you that can kind of enhance your score through some of these other factors as well. So the first one that we're going to look at, and I'll kind of run us through this quickly. First factor here, is payment history. Now, there is a whole lot that can happen in the journey here with payment history, okay? So I'll move you into this middle section. Well, sometimes a payment history will reflect bankruptcy, foreclosures, liens, garnishments. There's all sorts of things here. This is kind of the worst case scenario. So, if you have a prior bankruptcy, or you had a foreclosure or a garnishment or something like that, all that activity that was leading up to that outcome, bankruptcy, foreclosure, lien, etc., anything that happened there, all reflected in late payment history. It's all payment history related. So all of that activity in itself created a diminished score. That was one thing, that's one factor in itself that would just bring your score way down, particularly a bankruptcy, okay? Or if you don't fall into that situation, you find yourself overextended and you're just, consistently being late through time. That right there is going to also diminish your score, just late payments. Now on the other side, if you've had some problems and you've corrected those problems where you're having positive history, new accounts that are back on track, all those sorts of things, as that reflects through time, it's going to bring your score right back up. So it captures quite a lot. It's just not whether you're on time or late. It's a lot of other factors, a lot of other things here, like, bankruptcies, foreclosures, civil judgments, all that activity can reflect in payment history as well. But if you have been, consistently late or missed your due dates and those sorts of things, we really want to make sure that moving forward, after today, you want things to go back to being on time, because this is one of the most important. It is the single most important factor in your score. We must be on time. Missed accounts or anything that moves closer to charge-off status and delinquent accounts, that is going to bring your score significantly down through time. Outstanding debts, this is a big one. So if we've been late or overextended and things are starting to get really tough to make those payments on time, that activity really starts to reflect. It's usually related also to carrying a larger amount of debt. So you start to see how this model starts to, it's interrelated. So if you're carrying a lot of debt and you're consistently late, those 2 factors really start to weigh down your score, really start to bring it down through time. And then improving it is just kind of correcting those practices, moving things back the opposite way, getting back on time, paying down debts. But let's look at really what we're talking about here, because the key here is what I refer to it as a 30% rule. Okay, so keeping account balances below 30%. So you can take this, times whatever line of credit that you have. So particularly with what we call revolving accounts or credit card accounts, this is where the credit card market can really strengthen or really, damage your credit score. So if you've got, $5,000 line of credit times 0.30, whatever that line is, you multiply it by 30%. Once you cross that 30% threshold and move further out, risk continues to go up. That is delinquency and default. See, we're right back to that predicted value of credit scoring. The 30% rule is one of those great measures that can be used in the credit market, because if you're carrying, 80%, you're almost maxed out on a credit card. At 80%, the more debt you're carrying, the more likely you are to be in delinquency or default. So it's a high risk scenario at this point, and therefore you can't obtain any other lines of credit because it would only worsen through time. So again, back to that predictive value of scoring itself. So in our case, what we want to do is we want to shift that credit debt ratio, get things back below 30%. And we'll talk about ways to do this, but I'll encourage you to think about the holidays which are approaching. Many of us probably will cross this threshold. We're probably carrying some debt right now. We're probably going to spend a little more than we should, but it's really difficult sometimes once we max out several credit cards to really get down into 50 or 30% and lower, because as you know, credit card debt or these types of debts are not the only debts that we carry. These are obligations in addition to other obligations that we have to finance through time. So it becomes very difficult, and just paying things off means that we may just be stuck with monthly minimum payments. So that weighs down our score as well. So we'll talk more about how to diminish those debts, but I wanted to show you a quick graphic here. So, you start off, you were building some credit through over here where you only had 10% of that $5,000 credit card that was used. So you used your line of credit, you were using it regularly, your score went up to 753. And then as time went on, you started to kind of max this card out. Here's that utilization in real time. From 10 to 71%, you can see how this line starts to slope. You're down now to 617. Again, the predictive value of credit scoring. So what we're saying here is that now that you're carrying all this outstanding debt, the delinquency default rate goes way up. And this is where it gets really kind of, it brings your score down, becomes dangerous for you as well as a borrower. Is, how do you move that the other way? How do you get out of debt? So again, be careful this Christmas. Don't put yourself too far into debt. We don't want to be paying off Christmas debt, at the end of 2026. But just use some caution. And you can start to see here, though, again, that impact of scoring itself. So shifting that credit debt ratio, paying those debts down, getting things closer to 50, 30% and downward, that's going to move your score right back up. All right, so length of credit history, another one that we'll look at here quickly, thinking about the holidays. This one can be really tricky. Now, if your score is on the higher side and you get an opportunity to finance for, 12, 24 months at 0 interest rate, and you've got the capacity to do it, then opening an account like this will save you some money, no question about it. But if you're going to open and close accounts this holiday season, we might want to think that through, okay? Because length of credit history it's important because it's a factor, a point value in your overall credit score. So let's say that you're doing well with your payments and you're managing your outstanding debts, but you're opening and closing accounts through time. What happens is that too will start to lower your score. Okay, so credit scoring, again, back to that predictive value concept. If you're opening and closing accounts, it really throws off the logic of scoring. Scoring wants to look at accounts that are used through a longer period of time. Think about it like this. If I only know something about you over the next 90 days, it's very different than knowing your behavior over 6 years. So it's the same concept here, that predictive value of time. What are those patterns? What does it look like in a broader kind of period? So opening and closing lines of credit comes with penalty. FICO warns against it because opening new lines can also introduce risk into your score itself. You could go and max that card out tomorrow and put other lines of credit at risk. So you don't want to open and close accounts if you need some additional lines of credit, or maybe you even need a line of credit to finance some holiday spending, as opposed to just going into the credit card market to do that. Might want to talk to the credit union. A reasonable personal line of credit, $2,500 or something like that you can finance on an installment line. Have a wonderful holiday, pay it off, build your credit, as opposed to $2,500 or more that you put on a credit card at a 29% interest rate. So there are opportunities, but I just want to caution you against opening and closing accounts, because it does introduce risk. And then closing accounts can also affect your credit debt ratio. So if you're carrying, some credit card debt and you close an account, it may shift your credit debt ratio to look higher, and that too lowers your score. So a lot can happen in just what otherwise seems like a pretty simple practice of opening and closing accounts. Inquiries itself, again, I'm going to caution you against this, because hard inquiries, they matter and they do stick around on the credit report. Soft inquiries, no impact to your score. But again, the key here with inquiries is that if you don't believe that you have a score, or you're concerned that you've had outstanding debts and your score is just not that strong, trying to open an account at this point is just a bad idea. It just truly is. So we want to be careful about trying to apply for accounts where our score doesn't meet the minimum qualification. Again, one of the things that we want to encourage you on the call to do today is that if you are interested in a line of credit, use our practices to help you, okay? So I can pull the credit report through Trinity, go in and speak to a loan officer, let us work together. That's why we're here today. We want to be able to pull a credit report for you, evaluate your score, as opposed to you randomly kind of applying for things and it's not working out. Let us do some work for you. It will improve your credit capacity through time, and you will avoid having multiple inquiries that create kind of a negative image to the credit report itself. These can have implications over time. It can lower your score. And then lastly, what's called a credit mix. Okay, so go back to this concept of a thin file. Thinking about a credit mix is, what types of credit do you actually have? Are you overly reliant on credit cards? Do you have a student loan? Do you have an installment line of credit? Do you have a home loan? What kind of credit lines do you actually have? So a thin file may only have a secured credit line, or maybe a single credit card. So in terms of credit mix, you're not getting the full point value. Okay, so what we're looking at here is we want to kind of broaden your credit mix. So FICO suggests 3 revolving, that'd be 3 credit card accounts, no more than 7. I will say if you have 7 credit cards, you're probably going to be in trouble. It's just very difficult through time to manage 7 cards. In my practices anyway, it's been, I see a lot of debt once we get into higher numbers. But it's important, to have a credit mix, particularly when we get into higher dollar loans, business lines of credit, or getting into a home itself. Having a stronger credit mix is going to reflect better in your score. This can take time to develop, so it doesn't happen overnight. But our goal, if we pull a report, is to strengthen that credit mix. So various lines of credit that are offered through the credit union, this is where, General Electric can really help in building that credit mix. If you're newer to credit, you're a thin file, or you need to finance something over, a shorter period of time, 12, 24 months, this can be a great way through a personal line or a smaller line of credit to build this mix so that post 24 months, that's your future home loan right there. Okay, now we've used the types of cards that we need. We've got installment lines. You know, maybe I've paid off a car. I'm ready now for a larger purchase. So let us help you if you have any questions about a credit mix. So in our time that we have remaining, just to summarize, you know, that kind of paints a broad picture for you for the predicted value of scoring, how segmentation works, and really I've tried to lay out, you know, several scenarios, everything from thin file to enhancing. I've also talked about the factors that make up your score. We're going to shift gears a little bit now and just look at some debt collection strategies and how to get out. If you've had any type of issues with outstanding debts, just quickly some things that you can do to strengthen your score. I've made a point here that I've said paying debts alone does not build credit. I want to really focus on that point for a moment. We need to do debt management. We need to focus on debt management and pay off outstanding debts, collection accounts, whatever it may be. But I want to encourage you, if you're on the call, we must have something active and positive reporting to our credit report. So if you're just entirely focused on debts and you're not taking steps to rebuild your history, that is positive payment history or a line of credit, something else is reporting positive to the credit bureaus themselves, we're not going to be able to raise our score. Okay, and I see this all the time. Folks get entirely focused on the debt side and they forget that we have to do two actions. We have to pay off some debts, and then we also have to have active open lines of credit to build our score. So there's lots of things to be done here, okay? So I've seen a whole range of things. I talk about, you know, tackling some things, some quick wins or low-hanging fruit, however you want to call it. But here's the thing. If you have accounts that are delinquent, let's get them back on track. You know, if they haven't gone to charge-off status, we just want to get these accounts back on track. You know, once you reach 90 days, 90 to 120 days of non-payment, that account can be sold to a collection. It'd be charge-off account at that point. Then it's a whole different scenario. So if we're just, you know, if we need to do some budgeting, if we need to look at ways to kind of get these accounts back on track, that's going to reflect in our payment history. We want to work on that particular issue quickly before it gets to a charge-off status. And then, you know, if we want to try to shift that credit debt ratio, let us work with you. We'll work through that process to try to figure out a way. There's calculators and some other ways that I can show you just based on 50 to 75 extra dollars that we can really kind of shift that credit debt ratio through time. Those are some quicker wins that we can take right now. But again, key to these improved strategies is we need to pull a credit report for you. Work with us at the credit union, work with us at Trinity, we can partner to really align a strategy that best fits your needs. And then also, let's just quickly run through several debt repayment strategies itself. You know, these can take a little longer, but I think these are three fundamental strategies that you can use if you're trying to go, you know, through budgeting and trying to align a way to repay some of your outstanding debts. The first method that we look at is called credit utilization. So again, this is shifting the credit debt ratio itself. We're back to that 30% rule that I talked about. What we're going to do here is we're going to rank order your debts from lowest to highest. And then what we're going to be able to do is we'll look at trying to find a way to shave off the balances, you know, across. Let's just say we have 3 credit cards that we're kind of working through right now. We're going to shave off the balances on those 3 credit cards. We may not be able to pay them all off right now, but we're shifting the utilization rate. So remember that chart that I showed you, you know, once you get out beyond 30%, that score begins to drop. So card 1, 2, and 3, we want to find a way to really emphasize getting that first card down so that it's, you know, maybe we're at 80, we want to get to maybe 60 in card 2, you know, find a way to get it down 10% and kind of move our way so that in the end, what we're doing is by shaving off those balances on the outside, now instead of being 80%, we're at 60%. Well, our score goes up, and then we just keep doing that process until we can get down to 30 and then paid off. This is kind of a 24-month goal on all 3 of these strategies, but you know, utilization, you can shift the credit debt ratio, you will start to see that score move back up. I've talked about the consequences of this method before, but it's very efficient. And I also think it's very motivational. When you start to see movement, that becomes exciting. It just locks you in on personal finance. I think it's very important in your credit journey to see credit score improvement. And this is a great method to do that. Interest rate method, some folks want to focus on the interest rate. There's lots of arguments we can make about that, but here we're rank ordering. What we're trying to do is we're paying off the highest interest rate card. If you're going to go down this path, calculator.net is a great tool to use. You would plug in your interest rate. It will quantify that number. So what we would look at is the exact number that's needed to pay off and to shift the interest rate, as opposed, what I will tell you with interest rate is we want to be consistent through time. So if you use this strategy, you know, and your monthly minimum payment is, let's just say it's $120 a month, and we want to pay $160 a month, we really have, in order to accelerate the loan repayment, we have to be consistent through time. It can't vary every month. We have to stay on that number 160 until we get to the interest rate reduction or the payment reductions that we need. We start to move that debt down. If you have questions about that, let me know, but calculator.net does a great job with an interest rate calculator that can show you the exact amount to move that number down. And then lastly, the rollover method, which is sometimes you'll hear in media and other places, they call it the snowball, debt snowball, but rank ordering things from lowest to highest, making monthly minimum payments. But in this particular case, we're trying to pay one card completely off as opposed to shifting the credit debt ratio. We're focusing, we're taking our monthly minimum, increasing an amount until we just pay that entire card off. And then we move that full value to card 2, we bring that one down, and then card 3, and we're done. Paid all of our debt off. But the difference here is that we're rolling forward the repayment. We have to pay at least one card completely off, move those funds next to card 2 and 3. So I want to close by just giving you a word of caution on buy now, pay later. And then we'll open it up for questions. But buy now, pay later. This is just it's becoming more and more of an issue in terms of folks getting themselves into significant debt. So I wanted to make an issue. I want to make an issue out of it for us as we think about the holiday season. There are a number of companies that are in the market at this point, and the growth in buy now, pay later has just exploded. And I'm sure that there are folks that on the call that may have used it or may be thinking about using it. As with all financial tools and lines of credit, things can be positive and negative depending on how it's used and how we use these particular lines of credit. But I want you to be careful this season. We've talked today about improving our capacity, thinking about the future, having a strong score so that we can really have a strong financial plan moving into 2026. Buy now, pay later, I'm seeing just more and more of this creep in to overextending many borrowers and throwing larger loans at risk. Okay, so a couple things here that I want you to be aware of. While buy now, pay later can structure your payments in that pay in 4 scheme, because you have to set up auto pay and it pulls from a bank, your account, one of the risks here is that we just wind up running out of cash. Okay, so debt accumulation risk. That is, we've got too many of these accounts and they're all pulling in different times, and it starts to just become overwhelming. Okay, so that's one factor that just to be cautious, because we are heading into the holiday season, and it's easy to see, 4 payments and other things that we can take advantage of as opposed to one large payment that maybe we can't afford. The risk here is that we just overextend ourselves. Now, there's also a credit score implication that's on the way, and I'll share that with you. When we're thinking about credit scoring and buy now, pay later, the old rules no longer apply. FICO will be collecting information on a number of companies, particularly with Affirm, but other companies will be moving into this market. It's now a scoring requirement. And companies are kind of moving this in at different times. So I can't give you exactly an update on that because it just started, within the last 2 months. But, loan stacking, splitting payments, all of these things come with a lot of risk. And it's very easy to do because we're shifting those payments in four payments. So the problem here is, again, we become overextended, we're stacking loan upon loan, and eventually we get ourselves into trouble. And this is again what I was talking about, the buy now, pay later scoring method. So here we are now, Experian, TransUnion, Equifax, they will start to make, payments, late payments will start to count. So that's that payment history function of your credit score. So please just be careful. That's the message I want to share with you tonight. As we enter into this holiday season, and they'll Affirm, PayPal, Klarna, Apple Pay, there's all sorts of ways to do this, but it's still the same outcome. If you get overextended and you're overdrafting your account and you've got loan stacking, you've got multiple, payments all coming out, that can really throw off our plans for building a strong score in 2026. Then we're kind of late payments, et cetera. All that activity can really start to diminish our broader financial plan. So just a word of caution to you about buy now, pay later. If you are interested in struggling to kind of creatively find ways to finance, again, you can always look at a credit builder line of credit. This could just be a $2,500 loan that you get from the credit union. And as opposed to making all these other payments, we can structure all that activity into just one payment amount. You have a set structure for how you finance the holidays. And at the end of that process, you actually will have a stronger score. You'll be on budget and you can strengthen your score through time. So just again, word of caution as we see more and more buy now, pay later and the impact to borrowers as they struggle to make multiple payments. So we're going to close there and I'm going to open up any questions, but I just want to say again, thank you to everyone who joined today. I know I try to cover a lot of ground in our time, but if you need any help, again, Trinity's always open to pull your report, to work with you. And we always value General Electric Credit Union and the work that they do. And we are very happy to be a partner. So any questions that you do have, please let me know. And again, happy holidays to everyone. And we will take questions now.
All right, thank you, Todd. We've got a couple minutes left for questions, so go ahead and submit any you may have thought of in the questions or in your chat feature, and we will get to as many as we can. The first question, Todd, is it better to pay off credit cards in full or leave a small balance?
Yeah, this question comes up a lot, okay? And I've really tried to track the answer down on this one, okay? I think that there was a period where it became, I don't know how this creeped into just media and just talking points about carrying a small balance. Paying an account off in full is always ideal, okay? Because if you're carrying any increment, that's going to reflect in your overall, credit debt ratio. So ideally, it's, you have a certain amount, you pay that amount off in full, then you get the full point value for having it paid. Now, I think what happens is though, in a lot of cases where this became, I don't want to call it a myth, but what we see is that if you carry a small balance and you've utilized a line, positive payment history is really what starts to happen here. So let's just say that a small balance being you originally used $1,000. A small balance now is maybe you've got $100 or more, $200 that you haven't paid off. That positive payment history is really what's probably strengthening the score, but it's always going to be full point value for fully paying off an account. So I hope that helps.
This next question, excuse me. This next question is asking, what is the difference between a soft inquiry and a hard inquiry?
Yeah, good question. So a soft inquiry, and you'll find this in lots of different contexts. This could be everything from employment verification, it could be rental applications, it could be situations where they need to verify identity, verify other information about you personally. The issue here is that, break this down very simply. Hard inquiry is when you're asking someone to loan you money. Soft inquiries, typically, there's no hard credit pull because you're not, that's the key difference. You're not asking for money. It's just using your information to verify certain pieces of information that someone needs. So very simple, hard inquiry, you're looking to borrow or you're asking someone for money to finance a particular thing as opposed to someone pulling simply for information. So hard and soft inquiry. Yep.
Thank you. This next question is asking, is it possible to have a higher secured credit card limit or loan? For example, 5,000 or even 10,000.
Well, and when we get to the secured credit market, really, the beauty of the secured credit market is that it's smaller dollar and that it's there for, again, thin file, younger borrowers or borrowers that have really had a tough time, maybe hardship of all sorts of things that can happen where they just have a low score or maybe no score. Okay, could have been something like, you had an accident, you lost your job. It could be all sorts of things. And secured credit cards are really, somewhere between $500, $500. Sometimes it can go a little higher. But once you get beyond like $1,000, the secured credit line is really not the tool that you use. So for high dollar, something in $10,000 range, that would be, you would be looking at other ways to do that, other finance tools to do that. So it would not be a secured card to do that. The best way on something like that, again, we're going to build your score through time, and then we're going to capture all that activity to make certain that as we're financing that $10,000 or once we get to those higher dollar amounts, we want that activity to be reported so that it shows positively on the report. The key difference here again, though, is that secured lines really have a smaller dollar threshold. They don't cross in beyond probably $1,000, what we might call credit building lines of credit. So it's just not applicable to, high dollar lines of credit like $10,000. Doesn't function that way in the market.
But with that, that is going to conclude today's webinar. Thank you all so much for joining us and have a great rest of your day.